When Ulysses S. Grant left the White House in 1877, he was celebrated as the general who saved the Union and the president who had overseen Reconstruction. He was not a wealthy man by the standards of the Gilded Age, but his name commanded extraordinary public trust. After returning from a world tour and settling in New York City around 1880, he found that investors and financiers competed for the prestige of associating with him. That reputation, built over a lifetime of public service, would become the raw material for one of the most audacious financial frauds of the 19th century. In 1880, Grant went into business with his son Ulysses Grant Jr. and a young financier named Ferdinand Ward. Ward was charming, well-connected, and genuinely skilled at raising money from wealthy New Yorkers who wanted proximity to whatever Grant touched. A fourth partner, James D. Fish, was president of the Marine National Bank on Broadway. The firm's stated purpose was to manage investments linked to government contracts, and Ward told both outside investors and his own partners that he held inside arrangements with Washington that generated unusually high returns. He did not. He had fabricated those arrangements entirely. Ward ran what financial historians describe as a circular borrowing scheme. He would deposit fabricated government contract paper with the Marine National Bank as collateral and borrow against it. He would simultaneously solicit outside investors with the same false story. He then used new borrowing to pay the appearance of returns on earlier borrowing while diverting funds for his own use. The firm's books showed impressive profits. The actual underlying assets were nearly worthless. As historian Gene Edward Smith documented in his 2001 biography of Grant published by Simon & Schuster, Ward sometimes borrowed from both the bank and a private investor simultaneously against the same fictional contract, doubling the fictitious collateral. The Grant name functioned as its own due diligence. Wealthy New Yorkers who might have scrutinized a stranger's books assumed that an ex-president would not associate himself with a fraud. James Fish at the Marine National Bank extended credit well beyond sound lending limits for the same reason. Ward understood this dynamic and exploited it deliberately. He kept Grant himself almost entirely uninformed, telling him only that business was going exceptionally well. Grant relayed that news happily to friends, who then became investors. The fraud grew for roughly 4 years precisely because the social architecture of trust made skepticism feel like an insult to the general. By early May 1884, the Marine National Bank was on the edge of insolvency. Fish had lent depositors money into the Grant and Ward fiction and could not cover withdrawal demands. On May 6, 1884, Grant and Ward suspended payments, announcing it could not meet its obligations. The Marine National Bank failed around the same period. Ward had reportedly told Grant just days before the collapse that the firm needed a short-term bridge to cover a temporary cash shortfall. According to biographer Gene Edward Smith and other accounts, Grant personally borrowed $150,000 from the industrialist William H. Vanderbilt to help. That money vanished immediately. When Grant went to the firm's offices on May 6th and asked to see the books, there was almost nothing there. The failure of Grant and Ward and of the Marine National Bank sent a shock through New York's financial district. Within days, at least 2 other institutions, the Metropolitan Bank of New York and the Second National Bank, came under severe pressure from depositors demanding their funds. According to OMW Sprague's 1910 study, History of Crises Under the National Banking System, published by the National Monetary Commission, the New York money market locked up as banks began hoarding reserves rather than lending to each other. It is important to note, as historians of the period have argued, that the Panic of 1884 was not purely a product of the Ward fraud. American railroads had been overextending credit for years, and European investors had already been pulling capital from American markets, conditions that made the banking system fragile before Ward's scheme unraveled. The New York Clearing House Association responded by deploying a tool it had used in earlier crises, clearing house loan certificates. Member banks could deposit their loan portfolios with the clearinghouse in exchange for certificates that other member banks would accept as equivalent to cash when settling accounts. This allowed banks to clear obligations with each other without draining their actual currency reserves. Sprague's study, available through the Federal Reserve Bank of St. Louis's Fraser Archive, records that the clearinghouse issued approximately $24.9 million in these certificates during the 1884 episode. It was not the first use of this mechanism. The clearinghouse had deployed versions of it during the panics of 1857 and 1873. The 1884 episode reinforced the practice and demonstrated again that coordinated institutional action could arrest a cascade before it became a full collapse. The certificate mechanism succeeded primarily because the major New York banks agreed to treat each other's certificates as equivalent to cash, preserving confidence in the clearing system even while individual banks faced pressure. The panic that had looked in early May as though it might spread nationally was substantially contained within New York by early summer. There was real damage. Several institutions failed, credit tightened sharply, and many businesses found it harder to borrow. But the broader, prolonged contraction that had followed the Panic of 1873 did not repeat. Sprague and later economists studying the national banking era attributed the difference primarily to the speed and collective coherence of the clearinghouse response. Grant was left with almost nothing. He had lost his own savings, carried personal liability connected to the firm's debts, and could not afford the ordinary expenses of a former president's household. He was also diagnosed with throat cancer in late 1884. Facing financial ruin and a terminal illness at the same time, Grant began writing his memoirs. His friend Samuel Clemens, known to readers as Mark Twain, recognized the manuscript's commercial potential and offered to publish it through his own firm, Charles L. Webster and Company. Grant finished the final pages of his 2-volume personal memoirs just days before dying on July 23, 1885. The memoirs, which focused on his military career, became an immediate critical and commercial success and provided his family with significant income at a moment when they had almost none. Ferdinand Ward was arrested, tried, and convicted of fraud. He was sentenced to 10 years in the New York State prison at Sing Sing, though he was released before completing the full term, having served roughly 6 years and 9 months according to historical records. Fish, the bank president, was also convicted and imprisoned. After his release, Ward made various attempts to rehabilitate his public standing and reportedly sought to profit from his own notoriety. None of those efforts came to much. His name remained fixed in financial history as a specific example of how a trusted partner's reputation can be weaponized as a mechanism for fraud against the very people who trusted that reputation most. The Panic of 1884 and the clearinghouse's response added to a slow accumulation of evidence that private, voluntary coordination among banks carried real structural limits. The certificates worked in 1884, but they required unanimous cooperation from competing institutions, took days to organize, and could only be issued by the New York Clearinghouse, leaving banks in other cities without any backstop at all. Those same vulnerabilities reappeared in the Panic of 1893 and with far greater severity in 1907. The National Monetary Commission, created by Congress in the wake of 1907, commissioned Sprague's History of National Banking Era Panics specifically to understand how the system had failed and how the improvised responses had worked. That study directly informed the debates that produced the Federal Reserve Act of 1913, which created a formal, geographically broad lender of last resort with the speed and reach that clearinghouse certificates could only approximate. The Federal Reserve's discount window, the FDIC's deposit insurance, and the clearing infrastructure that settles trillions of dollars in transactions every day are all, in part, institutional answers to the pattern that the national banking era made visible again and again. When trust collapses, even solvent institutions can fail if no credible source of emergency liquidity exists. The Grant and Ward episode illustrates something that remains true in every era. The reputational credibility of a trusted name does not substitute for actual examination of the books. And a financial system that relies on the voluntary goodwill of its largest players to hold together in a crisis is always one bad week away from discovering exactly what it is missing.